right, for more on what to watch this earnings season, let's welcome in now Eric Freedman. He is the Chief Investment Officer at U.S. Bank Asset Management Group. Eric, it's good to see you. So you heard Julie and I, we were just talking about the big banks. Eric, you saw those earnings report. Just broadly, Eric, I'm interested to get your take on just what you made of those reports and any broader kind of takeaways you think for the market there, Eric.
Yeah, Josh, thanks so much for having us on. And I work for a big bank, so I can't get too much into the specifics, but I'll just say this. I think one of the things that really underscores our bullish thesis is the idea that the consumer is still hanging in there. You did a good job of covering that in the prior segment. That's what we actually heard from these earnings, or that consumers are still, in fact, outspending. Again, there's a difference, there's a divergence across the different cohorts of consumer spending, but in general, you're still seeing real incomes, again, inflation adjusted, still hanging in there. So that says to us that there's still a good backdrop for consumer spending. One of the reasons why we think corporate earnings cycle profits will continue, and certainly keeps us bullish in the near term.
And Eric, what does it look like in terms of that breadth? You know, we've been talking going into this earnings season, not just about breadth of performance, stock performance, but about breadth of earnings performance. And we're very, very early. We've heard not just from the banks, but as I mentioned, a couple of consumer staple stocks. So are we going to get that breadth of earnings growth from other companies?
Yeah, it's a great question, Julie. I think that it's probably early, at least for this quarter, to see it really fanning out. But the great thing about markets is that we anticipate before it happens. At least we try to anticipate before it happens. So part of our thinking, again, we've been actually overweight stocks through equal weight. And that's a long-winded way of saying that we think that large caps is where you want to be. We want to be exposed to those sectors that actually have not performed as well, but also don't have as much refinancing risk as small caps, or have a better profitability projection. So that's been really one of our key theses, has been this idea that equal weight will be a good place to add value. That has played out over the last couple of days, but it's been a pretty slow ride since we put it on in late April. So bottom line is that, you know, for our general thinking, that earnings are still in a decent spot. Consumer spending will probably come in a little bit, but again, on a real basis, you're still seeing incomes that are positive. So I think that if you look at sectors that we really like in terms of areas that are more attractive to us, things like energy, things like consumer discretionary, we still like tech. We would be at very least market weight technology. We think, again, the fundamentals of AI are still there. That's going to continue to broaden out. But there should be, again, a premium placed on companies that don't have as much refinancing risk, that still have decent earnings. That really leads us to that equal weighted position right now.
Eric, I just want to get your take on small caps because they're higher here again. I'm just curious, Eric, you know, why you think they're higher? Why investors have moved in at this moment? Is it because investors, you know, they've decided, okay, the economy is decent and cuts are on the way, and that's good enough to move into those pint-sized companies?
Yeah, Josh, I think the biggest variable driving small cap right now is because interest rates are coming down. And if you think about the data we got this week, again, your team always does a great job of thinking about and mapping out the week ahead and the week that's just happened. So the consumer price index data yesterday, the producer price index data today, those were both relatively benign. And it actually was a pull forward in rate cut expectations. You have to keep in mind that even though people generally don't think of it this way, that small caps, about 30% of small caps are actually debt financed. And so if you look at what that means is that, hey, these are companies that don't have as diversified revenues as either a mid cap or a large cap stock. And so they're very dependent on a product cycle. They're also very dependent on interest rates coming down to get their cost of capital lower. So what that really means is that as you have a pull forward in expectation for rate cuts, that's more bullish for small caps because of their reliance on debt. Most people think that small caps are mostly equity financed. They're not. There's a lot of debt contingency on small caps. That's why they're doing so well.
Eric, there's been a lot of talk about with interest rates where they are. A lot of people are in cash right now, or the equivalent of cash. What is the trigger that might get them back into the market? And is that going to be, you know, sort of an underpinning for stocks for this year?
Yeah, Julie, I think it's an important focal point. It's something that we see a lot with our client base, that clients, again, are almost nostalgic for higher rates in the cash part of their portfolios. The same thing that I think will get things, you know, shifted back into a broader allocation into stocks and bonds and alternatives is just probably the front end coming down. We think it's going to be a very gradual pace. And so I think that as people look to refinance and even think about laddering CDs and things of that nature, which again, we think there's a big opportunity cost in being in cash right now. We would be in other sectors and very happy to talk about those that we like. But I do think it's going to really require the front end to come down. People tend to be pretty hesitant to move out of cash. They tend to be, again, more focused on current yield. And that's something that we think is going to probably change, especially as we start to see that broadening of participation increase, which again, we're positioned for in our portfolios. But that would be the other thing that really gets people to think, hey, it's not just tech, it's not just comm services, it's not just discretionary, but other things are working. It's time for me to come out and get involved. That could be the catalyst that we see draws people away from cash.
Eric, thanks so much. Appreciate it. Have a great weekend.
Yeah, do the same. Thanks for having me.
Thanks.